Hello, good afternoon. My name is Axel Vera, and today I am making my project for my class of international marketing. So the assignment was to choose one topic from the course that I really enjoyed and maybe that I wanted to learn a little bit more about. And so what I did was that I chose international flow of funds and exchange rates. I found this particular part of the course really important because it really applies to me in so many forms. Uh, I find it very interesting as well because I think it's in every transaction that that we go through as human beings in this world in today's century. So with no further ado, let's get into it right away. And so basically, international flow of funds refers to the movement of money between countries. This flow of funds can take many forms, such as foreign direct investment, portfolio investment, and or foreign aid. One of the key drivers to international flow of funds is exchange rates. Exchange rates represents the value of one currency in relation to another currency. When exchange rates fluctuate, it can impact the flow of funds between countries. And there's many examples to this. Of course, every country goes through this. Every exchange is very different, and of course, one affects the other one. But for this particular example, I chose to talk about the exchange rate between the U.S. dollar and the Japanese yen. Um, so how this works is that it impacts the flow of funds between the two countries. If the exchange rate favors the US dollar, Japanese investors may be more likely to invest in US assets, such as stocks or real estate, for example. On the other hand, if the exchange rate favors the Japanese yen, US investors may be more likely to invest in Japanese assets. And just like it happens between these two countries, it can happen with any other country that you can imagine. Mexico, China, Russia, you name it. It's everywhere. In addition to impacting investment decisions, exchange rates can also impact the balance of trade between countries. When one country's currency is stronger than another's current country's currency, it can make imports from the weaker currency country more expensive. This can lead to decrease in imports and an increase in exports, as domestic products, the GDP, becomes relatively cheaper for foreign buyers. Central banks can also play a huge role in this international flow of funds and exchange rates. By adjusting interest rates, central banks can impact the value of the currency relative to other currencies. For example, if a central bank raises interest rates, it can make its currency more attractive to foreign investors, which can increase the flow of funds into the country. But if the interest rates are raised too high, it can also slow down the economic growth and lead to inflation, which is a very good example when, if you put into perspective into the 2020 pandemic and the inflation, everything was so cheap, and then boom, everything started to rise again. Well, to finalize this, overall, the international flow of funds and exchange rates are very complex topics that are impacted by a variety of factors. Of course, like we talked about, investors, governments, and of course, central banks all play a huge role in shaping the flow of funds between the countries and the value of currency on the global market. Well, that's everything I have for today. I hope you enjoyed my video, and thank you so much.